This Black Friday, some retailers are urging customers to buy now before President-elect Trump's proposed tariffs take effect. Joining us now to talk the potential economic impact of these plans, Carl Weinberg, High Frequency Economics chief economist. Carl, thanks for joining us this morning.
Nice to see you, Steve. Happy Thanksgiving.
Yeah, happy Thanksgiving to you. Listen, I wanted you to help me puzzle through the math on this. There are three offsets I can think of to the tariffs. One is that the producer eats some of it, the retailer in America eats some of it, and some of it's offset by currencies. Does all of that work to seriously offset, somewhat offset, or not offset to any great degree the economic impact of tariffs?
Right. So you're right on all three counts, Steve. What we don't know anything about is we don't know anything about what the currency is going to do. And it could go up, it could go down. Economists aren't really good at predicting that, and the impact of a tariff is a special and complicated case. I think before we talk about who eats the cost of it, we want to go back to 2018 and just talk about those tariffs, because there was no impact on consumer prices at all that we can see at High Frequency Economics out of that round of tariffs. And what happened back then, which is very different from what's happening right now, is that tariffs were placed on selected goods, none of which were consumer goods. They were all intermediate goods. So there was no CPI impact. So if the reasoning is that these tariffs are going to do the same thing now that they did then, just more of that, that's wrong, because these will affect the prices of consumer goods that are coming across the border, all of our borders. So there will be a price increase. But you're absolutely right, Steve.
More importantly, though, you said in your notes, I didn't realize this, that the 18 tariffs were specifically crafted not to include anything in the CPI.
Well, either they were specifically crafted or it was an enormous coincidence that they missed almost all consumer goods. But shoppers at Target didn't see the prices of stuff go up at Target, the toys and consumer goods and small things and electronic goods and Apple phones and all that stuff. They didn't go up in price, but things that went up were things like capital equipment, machinery, parts, cars, parts for cars, things like that, chemicals, other things, intermediate products that affected companies. But remember, Steve, for companies, the cost of capital goods and the cost of input materials, they're only about maybe 15% of the total cost of producing everything. 80% of the cost of producing everything on average across the economy is labor, and that's unaffected by tariffs. However, this time, consumer goods are going to get hit.
Okay, do one more piece of math for me in our Econ 101 Thanksgiving Black Friday day. Why does the dollar strengthen when President-elect Trump threatens tariffs?
I don't know. I don't have a strong theory. I think in the markets, people are believing that there are going to be some inflationary impacts from the broad scope of policy proposals. That's maybe right. It's probably not as right as people think it is, because things like tariffs don't really cause inflation. They cause a one-time change in prices, which could become inflation. But
I think, Carl, the reason is interest rates. The reason might be, Carl, the reason might be is because you're going to have fewer dollars circulating in the global economy, and so in the shortage of dollars, people would pay up for them because there's less trade as a result of the tariffs. That's why the currency was strengthened.
Stephen, I applaud your thinking like an economist there, supply and demand for currency. But, you know, every time the price of oil goes up $10 or down $10, all right, a lot more world trade is affected than there is going to be affected by these tariffs. And that doesn't seem to knock the dollar either. So every once in a while, supply and demand of dollars affects the value of the currency. And a lot of the times it doesn't. Same thing with interest rates, which is what I think the market is thinking about now. I think the market is thinking that the Fed is going to have to pause cutting right now because there is a risk of inflationary policy. And while they can't act on that risk of inflation, they can pause to wait to see how it plays out. And this is what Chair Powell has been telling us. He's been saying, we've got room to pause. We don't have to be in a rush to ease because the economy is so strong. So I'm suspecting that the Fed is going to take advantage of the scope that it has to take its time cutting rates, to not let rates get too low just in case they have to reverse course. And in the meantime, the economy is doing just fine and doesn't really need an immediate rate cut to keep on going. So I think there's a really big question mark over that December rate cut that the market is pricing in. And that could be a basis for people buying the dollar right now, because right now, this week, it looks like rates might be on hold for the Fed, and that generally is considered to be a positive for the dollar. Whether there is or not doesn't matter. People believe it, and I think that might be what's driving it.
And Carl, in your math, how do you account for, or do you account for, retaliatory tariffs? We saw an interview from Christine Lagarde in the FT where she was urging Europe not to retaliate with their own tariffs, but in fact to buy more U.S. agricultural, defense, and other goods. Did we see an impact from retaliatory tariffs in 2018, 2019, and do you expect that this time around? And how does that filter through?
Yes, so in 2018, 2019, we saw tit-for-tat tariffs. So the things that they tariffed that we export were things that also were intermediate goods and not necessarily consumer goods. So the impact worldwide of this tariff increase was very muted back then, but that's different from across-the-board tariffs. Now, the real question, which I can't answer because I'm just a simple economist, right, is why is Trump asserting that he's going to do this? Is he actually going to do this, or is this a negotiating tool? Right? It's stated, as he declared it on his posts, that what he really wants to do is he doesn't want to put tariffs on these countries at these rates. He wants to slow the flow of people and drugs across the border, and he wants to compel, particularly Canada and Mexico, to do something about it. So let's wait and see how this all plays out. The presidents of Mexico, the Prime Minister of Canada have already been on the phone with Trump. His people haven't even gotten to their offices yet. So I think this could very well just turn out to be a negotiating ploy.